What's up you guys, it's Paul here. I wanted to do a quick follow-up to yesterday's video on how I made a 761% profit trading Pinterest call options around earnings, okay? Now, towards the end of that video, I briefly talked about a strategy called the Strangle, where you buy a call and a put at different strike prices, and you're taking advantage of the volatility in the stock price to make exponential returns, okay? But I realized that I should probably give more details around it, explain why it works like that, and give you actual examples to show you why it's such an effective strategy, okay? Now, before I get into it, I just wanted to let you know that if you're looking at buying any call options on Pinterest right now after earnings, be very careful, because if you look at Pinterest options here, a lot of the options have already shot up 900 to 1,000%. So at this point, if you want to buy any call options, you're overpaying for it because they're very, very expensive, okay? So you should never chase any call options after a stock has gone up a lot, nor should you chase any put options if a stock has gone down a lot, okay? So be careful about that. If you missed out on this particular earnings trade, don't try to chase it. Try it on a different stock or some other time, but don't chase it right now, okay? Now, like I mentioned, for a Strangle, you want to buy a call and a put at different strike prices, and the reason you do that is because if a stock goes up 36% like Pinterest did, the call options can go up 900 to 1,000%, but the put option on the other side can go down at the most only 100%. So even though the put might expire worthless, you could still 7 or 8x your money on the call side. Inversely, if the Pinterest had gone down 36%, the calls would have expired worthless, but on the put side, you would have made 7 or 800% return, okay? Now, the way I choose what call or put that I want to buy is to use this website called tradingview.com, where I look at how much Pinterest moved historically after earnings, okay? So the last time Pinterest announced earnings was on May 5th here, where it was trading around $20.60, and after earnings it dropped to $17.50, which was approximately a $3 move. Around here it went from, say, around $23.45 to $25.40, which is about a $2 move. Around here it dropped from $24.67 to 21. So on an average, Pinterest is moving around $3 either up or down after earnings, okay? So that gives me a pretty good idea on how I should pick my call or put options and what kind of a range I should choose. Now, even though it's $3 or $4 after earnings move, I could also decide to buy further out of the money calls and puts in case I want to buy cheaper options, okay? So in this particular case here, if you actually look at the history of Pinterest really quick, before earnings came out, Pinterest was trading around $25, and it was pretty much flat the entire day. So if I wanted to go $3 or $4 above for the call and $3 to $4 below for the put option, I would then look at the price of the option and then decide which one to buy. Now, in this case, for simplicity, let's say I went with the $30 call, which is almost $4 above. It already went up for $412 after earnings, but before that, you could have bought one call option for only $51, okay? So let's say you bought 5 of those calls. You would pay $255 for 5 of the $30 calls, okay? On the put side, let's say I went $5 below and went with the $20 put. Now, right now, the put is worthless because the stock went up so much. But prior to earnings, this was valued at $32 per put option. So let's say I bought 5 of those for $160. That now you would have paid a total of $415 to buy 5 of the $30 calls and 5 of the $20 puts. Okay. Now, after earnings, these put options and essentially expired worthless, meaning from the $415 you lost the full $160. So now your Strangle is only worth $255. But now on the call side, if you actually look at it, the call actually went up $412 per call option. So 412 times 5 is $2060. You add that to the $255 here. So that means you just turned $415 into $2315 in one day. Okay, so even though your put expired worthless, it doesn't really matter because the call option shot up like crazy. It shot up to by 807%. If you bought it on July 30th, you don't even have to buy it a week or a month earlier. This literally happened overnight. Okay, that's how strangles can be very effective. Let's look at another example for Apple here. So same thing with Apple. They announced earnings on July 30th after hours, and the stock went up 11% on July 31st that you can see here. So let's say you wanted to buy a Strangle on July 30th before Apple announced their earnings, okay? So if you look at the historical price of Apple here after earnings, on May 30th April when they announced earnings, they dropped from around 293 to around 288. Here they went up from approximately 316 to 325. Around here they went up from 243 to around 256. So I would say $10 to $15 would be a pretty decent move for Apple after earnings. Now in this case it moved $42, which is why it was a little unexpected. So I wouldn't have chosen $40 out of the money, but let's say I went with $20, okay? So same thing, expiring on August 7th again. Actually before that. So before earnings, Apple was trading around $384. So let's say I chose a call $20 above and I put $20 below. I would have ended up buying the $405 call on July 30th, and the value of that would have been $21.25 minus how much it went up, which is $18.72. So I would have paid $253 per call option. So let's say I bought two of those. I would have ended up paying $506 for two of the $405 call options. Now on the put side, let's say I went $20 below to buy the 365 put. Now it's down to $270, but the value of this put before earnings was $290. So if I bought two of those puts, that would have been $580. Add that to this, and I would have paid a total of $1,086 to buy two calls and two put options, and that would have been my Strangle strategy for Apple. Okay. Now after earnings, as you can see, this put option dropped by $270. So I subtract $540 for the two puts, but on the call side, the $405 call went up by $18.72. Okay, so for two call options, $18.72 times 2 is $37.44. And now that Strangle is worth $4,290. Okay, so in literally one day, you could have turned $1,086 for the Strangle into $4,290, even though on the put side, it pretty much is going to expire worthless. Okay, so that's what I wanted to show you guys. I wanted to demonstrate why and how a Strangle can be one of the most effective strategies that you can use around earnings and make exponential profits, irrespective of which way the stock moves. Okay, so if you enjoyed it, please hit the like button, guys, to support the channel so that it can reach other viewers like you. Leave a comment below if you have any questions, or if you wanted me to look at another stock around earnings. And be sure to subscribe and hit the notification bell so that you get notified of my future uploads, okay? So that's all for now, and until next time, thank you.